All right, so this will be module 7 for us. And this is going to be focusing on how we evaluate performance, right? So it's not enough to just say what your returns are, but we have to evaluate what the returns should have been, right? And there's ways for us to calculate that. We're going to talk about how we can adjust returns for risk. And we're also going to talk about how international exchanges also impact our investment returns. Okay, so the first couple conversations we're going to have is a time-weighted return, which basically just is our geometric average or geometric mean, right? So you just add 1 plus each of the rates, multiply them together, and then take the nth root of that and subtract 1, and that will tell you what the average return has been. A dollar weighted return is a bit different because what we're doing is we are looking at what the return on the investments are, given that we have different dollar amounts that we are putting in. So both of them have their own benefits and drawbacks. And some funds we evaluate one way or the other. So when we're comparing funds, right, or looking at risk, what we try to do is say, is this return that you received great enough for your risk, right? So, and there's a lot of different measures. So we're going to go through several of these, right? So the first is going to be the Sharpe ratio. This is one that we teach in investments. It's one of the early ones. So what you do is you look at the return that you have and then subtract off the risk-free rate. So that excess return divided by the standard deviation of your returns, right? So it's how much your return was divided by the level of risk that you were taking on. Trainer has a slightly different one where instead of dividing it by the standard deviation, it divides it by beta. And remember, beta is the covariance with the market divided by the variance of the market, right? So this looks at just what we call the systemic risk, not any of the idiosyncratic risk unique to that company, right? So it's a different measure, but it's also a risk-adjusted measure. Right. And then Jensen's alpha is another one, right? So we have the Sharpe ratio, we have Trainer, and then we have this Jensen alpha, where this is saying, let's see what we should have gotten based on the CAPM, right? We have a beta, we have a market return, we know the risk-free rate. So we can calculate what we should have received, and then we can get what we did receive. And then that difference we'll call alpha. So we hope that's a positive number. It could be negative. And if it's negative, we're underperforming what we should under the CAPM. This one's a little bit different. The information ratio, if you notice, it starts with alpha, right? So it looks at the abnormal return, and then it's dividing that by this non-systemic portion of risk, right? They call this the tracking error. But really what we're trying to say is, what was your outsized return divided by the amount of risk that you could have eliminated through diversification, right? So I'm getting an outsized alpha, but did I take on a lot of idiosyncratic risk, unique risk to that investment to get that alpha? Or was it based on something else? So they call that the information ratio, right? So in each of these, either the numerator or denominator will be slightly different. Another measure is this M2, right? And so the risk, the performance that we got in our portfolio minus what this market return would have been, okay? And so this right here is just comparing some of those, the Sharpe, the Trainer, the information ratio, right? And they all have advantages and disadvantages, right? As we're going through here, we just want to make sure we're picking like the most appropriate, but understand that we definitely need to keep an eye on all of these, right? And alpha, it pops up here also, but this is an important measure that we use a lot, because what alpha is that what I am getting for being actively managed, right? I could have gotten an index fund, not have the expenses of an active manager, right? And then would have performed, basically at market expectations, right? So we're, if you ever go and you see things like seeking alpha, and things like that, that's what people are trying to do, is to get that outsized return, right? So and so as far as our performance statistics, what we are seeking to do is to perform better, right? So we have these returns, right? And that's what we're hoping to do, right? Is get the best possible measure. Okay, and we've already talked about the security line, right? And so this is a way of talking about realized returns versus expected returns, because we haven't realized anything until we close out positions in the market. All right. Now, I think I've mentioned survivorship bias, but understand that anytime you're taking a sample of something that's true over a wide period, you're necessarily excluding things that died, right? That's why we call it survivorship bias. And so we're looking at the winners, through all of this. And so that's got to be something that we have to be very careful about as we're trying to evaluate our fund compared to some other funds, right? Because we're only looking at the ones that won, right? The style analysis, the way to think of this is, if I'm investing and I say that I am looking for small market cap firms that have a reinvestment policy where they don't pay dividends and they reinvest it back into the firm, I need to make sure that I am comparing it to similar types of holdings, right? And so that's what we're doing here, is to see how does it do once we're stuck within a particular style, right? I can't compare what I'm doing with someone else who's got a different style, right? Right. And then this is a measure of risk adjusted return, the MRAR, right? And so we know that the markets do change, right, over time. And so this is a way for us to take out a lot of timing issues, right? Because oftentimes, you'll try to do something near the end of a quarter or fiscal years and things like that, just so that you can take advantage of those types of market timing. And this MRAR is a way of pulling out the bits of the return in lots of different points in time to eliminate that, right? That way, it helps prevent a lot of that stuff. Market timing. Now I just mentioned that market timing is, we try to avoid that when we're looking at compensation and things like that. But this is a way for us to look at market timing. These are two different approaches, and how to sort of decompose that. And really what they're trying to do is come up with like the best possible measure for this timing, understanding that really what we're doing is we're basically creating a synthetic call through timing, right? Because if you think about like a call option, it would be the ability to sell, right? I've got a call. I could go out and value that ability, right? So here's an example of that, right? So I could go out and buy T-bills, and I'm going to put some amount of money and it's going to grow at the risk-free rate, right? That's what T-bills do. But then I have this implicit call where if the value gets above some strike price that I would want, right, then I get that call, because I could always just exercise that, right? I could always just go into the market and exercise in the event that the current stock price is above some exercise, right? And so it's by using the timing itself, it's a synthetic call that I don't have to pay for, right? Which is the best part. Right. And understand, I mean, I'm saying I don't have to pay for it. The fund manager doesn't have to pay for it, but I pay the fund manager, right? And that's part of what they are doing, is they're looking at these synthetic options in the market and then taking advantage of those to maximize the returns for the fund, right? Because that's how they're going to be evaluated, is on that. All right. So if I'm paying someone based on how they do, right, I have to separate out what is just the market, sort of like a rising tide lifts all boat, right? So how much of this is based on them being lucky, and how much of this is based on them being good, right? And so what we try to do is figure out, what the money is coming from, right? And so you notice the first thing we look at is like the broad asset allocation, right? And how that works. And then looking within the market, how they chose industries or chose sectors, right? And then how they chose individual securities within each sector, right? So there's different levels on which to evaluate performance. But this is how we could have the market as a whole do poorly, but we could say this fund is doing well, or this fund is doing poorly, even though the markets are up, but they're not performing as they should, just based on other performance. Right. And so one of these things that we can compare to is what we call a bogey. And it's just like, okay, if you were not actively managing and you just bought some sort of index, right? Then what would that have been? And then we were going to say, what was your return compared to that index, right? And so that would be a good way of trying to piece out what was their impact over a passive portfolio, which won't have the same expenses of active management. Right. So how do you do well? You buy a lot of stuff that performs well, and you don't buy stuff that performs poorly, as straightforward as that sounds. But that's exactly what we're looking at, right? And so that's where this manager is deciding when to enter in markets and when to exit markets, is to make sure they're catching as much return as possible. Okay, and so here's the market for equities, right? And so understand that as large as the United States is, about 40% of the world's stock capitalization is in the US. Well, that means almost 60% are not, right? And so we make up 40.6% of market cap. The developed world, as they say, makes up about 3/4 of the world's market cap. So it is still sort of a small group. If you ever hear about like the G7, the G6 and G7, this is what we're getting at is, there's just a small group of countries that drive a lot of this. But as we are looking, at these, just understand building these international portfolios, there is a good bit of money outside of US markets that we need to also invest in. All right, I'm just putting this up here just so that you understand some of this relationship between market capitalization and GDP. This is why companies or countries try to develop, really good legal framework and let companies grow and everything, because it drives the country's GDP. It drives growth within the country, right? So just to keep that in mind. Now, as we go through here, there is a bias that develops where people tend to own more stocks within their own country, right? This is true, of course, in the United States. Many people in the United States are almost exclusively invested in U.S. securities. But even that's true for like French investors. They're overweighted in French securities, and German investors overweight in German securities, and Japanese investors overweight in Japanese securities. There's a lot of familiarity, right, and that type of thing. And so there's a lot of reasons why this is true, but this bias does exist. So this is something we have to be careful of, because you can not get appropriate returns because you don't have a proper diversification. And so when we are investing internationally, we have to remember that not only do we have the performance of this foreign subsidiary, but they're getting paid in a foreign currency. So we have to look at not just what our returns were, but then how do those returns, translate back to us, back into US dollars. And we've looked at exchange rate before. And this is just a way of talking about US returns and UK returns and the level of risk that we have through this exchange rate, which could change over time. So first, let's kind of want to show you the formula that we're going to use, right? And then when we're talking about this, in the book, there's this table 25.3, which shows how some currencies can get extremely volatile, right? But we just went over forwards, and that was one of the big reasons for having forwards, is so that you can, diversify away a lot of this exchange rate risk, right? And so, in fact, that's what we're going to talk about next is how to hedge a lot of this exchange rate risk. So we're going to go back, rearrange what we had before, and then move our UK, over here to the other side. So we covered this when we were talking about hedging our exchange rate risk, but this is the exact formula we would use, because what we're trying to do is minimize our exposure to these types of changes. And this is just some information about some of the risks that we have within international markets. The United States and the United Kingdom, we have very long-term records, that we're able to look at. If you think about other even developed economies, I mentioned France, Germany, and Japan, but all three of those economies were significantly disrupted by both World War II and then the aftermath. All three of those countries have relatively recent governments, and that sort of thing. So when we're talking about, long-term data, a lot of times it becomes more difficult as you go international, because those were very strong economies. You can imagine former colonies and those types of like frontier and developing economies that you may want to invest in will have a lot of their own issues that we have to deal with as we're coming up with appropriate prices. But understand that one of the big reasons for investing overseas is to get more diversification. Now, part of the issue with diversification is we need things to not be correlated, right? If they're not correlated, our diversification is much stronger. And over time, you notice that first bullet point, the first one under that, it says international correlations have increased over time. This is what globalization has done, right? So a lot of corporations have very similar operations regardless of the country that they're located in. And so what you see is, boy, that German market looks a lot like the US market, and that French market looks a lot like the US market, and that Italian market looks a lot like the US market, right? Not perfectly, they're not perfectly correlated or anything like that, but this correlation has grown over time, which reduces some of the advantages of diversification. However, even if we are just putting things in other countries, there is some diversification benefit because they are not perfectly correlated, even when your economies are as tightly linked as, say, Canada and the United States, right? There are still going to be differences. Okay, and this role, had a paper that I remember reading, about the he does a lot with crashes, and so he was saying, that when there are increased uncertainty, this increases the standard deviation of returns, right? Our sigma, right? It gets noisier. And then that gives you an opportunity to take some advantage normally. But if they are all sort of dropping together, right? Like if you think about the financial crisis in 2008, but even recently with like COVID and so many economies shutting down at the same time, the diversification decreases because all of those economies behave the same. Here's one on political risk. This is, I'm recording this in 2022. Brazil just had an election, and no one won in the first election. So now it's going to be the incumbent Jair Bolsonaro going against Da Silva, who was the previous president of Brazil. And so if we had operations in Brazil, we don't know exactly what the impact of this election will be. And so we don't know exactly what the risk to our operations would be. But if we were working in, say, soybean production in the Pampas, or if we were doing, let's say, livestock in the Amazon, right? Each of those presidents have very different visions for agriculture within Brazil. As well as like ecological services. So we may have a lot of exposure in that, right? And so these are going to be an interesting wrinkle as you're investing internationally, right? So as we're investing internationally, the things that we're going to be focused on is going to be the currencies that we're dealing with. Some are much easier to get in and out of than others. And sometimes you can just stay in US dollars, right? And that can matter. The countries that we're picking, right? There's a lot of risk associated with different countries. They have different legal systems. How we pick the stocks themselves once we decide to enter into that country. And then the cash and bond selection, because we can hold these in multiple currencies and in multiple jurisdictions, right? And so these are the types of things that we're going to evaluate based on. So, and then this would conclude module 7, which is on our performance metrics.